Well, hello, Maverick traders. Welcome back to your currency midweek for June 29th, 2022. Corey here with you for the midweek. I had been under the weather for a couple of weeks there. I had COVID, and then I had kind of a secondary virus that had a little bit of almost an allergic reaction, just kind of felt terrible. Nothing serious, but just kind of been out of it for most of June. So I'm excited to be back to normal and a little more active in the markets. As always, a quick reminder to make sure you follow your trading plan, and let's get to it. So, as we look at the markets, 2022 has been pretty interesting in that a lot of volatility. There's certainly some themes in the currency markets. Crypto, 2022 is not going to be looked upon as being some fantastic time period. The crypto markets are broken. Interestingly enough, I've kind of talked about, I feel like we're at a little bit of a stage 4 kind of exhaustion phase where it's going to be bumpy, and usually when you hit a stage 4 exhaustion, it's not a bottoming point. Most people think, well, that means that you should go skyrocketing higher. No, not really. What typically happens is you go into a consolidative but kind of washed out phase. So will there be some downward slides? Yes. Will there be some upward jumps? Yes. If you feel that you're in this stage 4 exhaustion, the trade is to kind of fade the move. So basically, and when it looks worst, that's where you take profits on the bearish trades. When it starts to look good again, that's where you take profits on the bullish trades, and you just kind of fade the reactions, kind of buy on weakness, sell on strength. You're not really trend trading at that point. You're kind of fading those moves. So crypto, 2022, pretty wild market, but there's some other themes. So consumer confidence, wow, we're seeing 40 and 50-year lows in consumer confidence. The consumer, it's interesting, it's anecdotal. I was just having a conversation with my sister-in-law, and she was saying, it's going to get so bad, and everything's crashing, and it's going to be like, the worst in our lifetime. And I was kind of discussing this with her and saying, what, well, okay, it's probably, inflation's a problem, and people are suffering. I get it. We want a strong economy. We want a strong market. Every rising tide lifts all boats. I'm not rooting for recessions and so forth. But what in your life is worse now than it has been in history? Do you have worse on the healthcare side? Do you have worse on the, what you're able to do, the way you live your life, the access to food and water and clothing and entertainment? And so what in your life is worse? And my point was kind of, look, in every generation you go through these ups and downs, and it always feels like it's different this time. It always feels like, oh, it's so much worse today than it's ever been. But imagine you lived in World War One, you lived through the Great Depression, you lived through World War Two. Even if it wasn't a bad period of time, you lived through the 50s and 60s and 70s. Would you trade the lifestyle you have today to go back in time towards that lifestyle? And most people would say no. I like the fact that I can jump on a plane and be anywhere in the world, and I like certain aspects of it. So we kind of have to, there's always this pessimistic tone just amongst us as human beings, but I'm not sure that this kind of pessimistic tone, what I find a lot from traders is that newer traders equal bearish traders. People come into the markets and they're hardwired to just be kind of, it's what we do as humans. We kind of complain about circumstances and the economy and politicians and the Fed, and you tend to come into markets with a pessimistic viewpoint. And this is important to understand because you have to understand where your bias is in order to adjust and protect against it and so forth. And this is, I would say, I mean, 90% of people, not everyone, you might be the exception, but 90% of people, when they're newer to the markets, they're extremely pessimistic. And by the way, I mean, Maverick's been in business for many decades, right? This has not been true only of 2022, by the way. Any new traders we took on in 2021, in 2020, in 2019, in 2018, it's all the same, okay? Go back to the year 2000, 2001, 2002. As Maverick's been around, it's all the same. New traders equal pessimist, bearish, negative. And that is a bias. That is something that's ingrained inside of you that you've probably, as human beings, we kind of fuel that a little bit. And it's like this discussion I was having with her. She was just speaking her normal, kind of, oh, well, that this is going to get bad. It's going to get so bad. It's so, prices are out of control, gas. And you have to kind of take a step back and kind of say, okay, I know that I mean, consumer confidence is at multi-decade lows. I just want to spend some time on this because it's at an extreme right now. And the question you have to ask is, with this being at new multi-decade lows and the consumer feeling horrible, and you can understand why. Most people spend money on what? Well, food and energy. And those are the two things that kind of have the sticky inflation right now. Because if you're looking at all the other numbers, inflation and just different things have rolled over. I mean, copper way down, steel way down, lumber way down. The list goes on and on. Prices have collapsed in the majority of things have rolled over. You're seeing it sticky in food and energy, and that's kind of where the biggest problem lies. But I would tend to fade again the general public and kind of their sentiment, and when they all get on one side and are kind of pessimist on this side, I want to be an optimist on this side. And oh, by the way, if they're all extreme optimists over here on something, then I kind of want to separate myself as well. I mean, you definitely want to trade the trends, but you want to be very aware of where the public gets off sides. It's kind of like back in the year 2007 when I noticed, I just kind of said, everybody wants to own real estate, invest in real estate. Everyone I talk to is getting their realtor's license. There's all these interest only loans and so on. The general public in 2007 was just geared up towards real estate. I mean, it was just a fever. Something of a fever kind of went through crypto, where the average person had no opinion and no understanding of crypto. And the next thing you know, families are talking about it at Thanksgiving, and they're all buying these new coins, and they've got their family discussions about. And so just be aware of where sentiment is and where the general public is. My argument is that we're actually going to see a substantial drop off in inflation. And I think energy, interestingly enough, kind of sets up for a leg to the downside. It's been sticky, I get it. But so many other things are falling off. And part of what should fuel that, the US dollar has broken out to the upside and has broken out on a multi year basis. Now, the US dollar surging to the upside, that should be bad for commodities in general. Probably bad for gold. It's probably bad for silver. It's not especially good for crypto. The U.S. dollar has broken out. I mean, there's no debating that point. Now you might say, well, maybe it'll just kind of phase out. Maybe it won't go anywhere. Maybe that's the case. Maybe it'll have a failed breakout. Maybe, but it has broken out, on a multi-year basis. And the Swiss franc, kind of the same thing. The Swiss franc, we talked about this last week. What's interesting about the Swiss franc, and we noted this, remember we talk about knowns and unknowns, and the Swiss franc had one of the unknowns, and those are things that really fuel the market. So, what's an example of a known unknown? Well, a known unknown would be like, a company reporting earnings. You know they're going to report after the bell today. You just don't know what the numbers will be. Usually, because there's kind of this aspect of it that everybody's kind of geared up for. Known unknowns, yeah, there's an unknown aspect that'll fuel a little bit of volatility, but usually those are not major. When you get an unknown unknown, and by the way, known unknowns, I mean, in currency, we have these every day. The US just reported GDP. That's a known unknown. We knew the date, the time, that everything that GDP was going to be released. We just didn't know exactly what the number was going to be. But why is there not a huge reaction? Well, because if the GDP comes in zero point 0.1 better or zero point 0.1 worse, it's just not that big a deal, right? It's just not a huge shock and surprise. But sometimes you get an unknown unknown, something of a, hey, nobody had this on the calendar. Nobody was ready and prepared for this to happen. And then all the question marks of, well, since nobody knew it was going to happen, of course it can't be priced in. And now you got all the question marks of, okay, well, what does this mean for the future, and how off is the pricing of this asset? How much does it have to move to reflect this new situation? This is why unknown unknowns are so big, is because it's not already priced in any way, shape, or form. And the markets have to adjust and they have to reprice in dramatic fashion. If you had for example, a terrorist activity or something positive, a cure for cancer, whatever, it would be an unknown unknown in that nobody was prepared for it. And then there's all the questions of what comes next. What does this do for pricing of the US dollar and the Swiss franc and the Japanese yen and, all these sorts of things. And the Swiss francs had somewhat of an unknown unknown where they came out and they started selling their asset program. They had been buying aggressively into stocks and all sorts of things, and it was just not known. It was not expected. They weren't supposed to be shutting that down. They did a bunch of things. They hiked rates. I mean, it was the full-fledged deal. And you've seen the Swiss franc go crazy on the upside because it's just simply not priced in. But usually, when the dollar's breaking out, the Swiss franc is breaking out, and so on, that kind of speaks to a little bit of a defensive posturing. But I think, I mean, I'll be judged by this, but I've been saying it for the past few weeks. I think we actually are starting to see inflation rolling over. It won't be a quick, dramatic decline, but we're going back towards 6% and 5%. And it wouldn't shock me if we're talking about, 2% inflation rates by this time next year. We'll see. But anyway, I think we've already started to see it. I mean, if you look across the board, you look at those charts, I mean, lumber's down 50%, copper's down dramatically, steel's down dramatically. There is some things happening that way. Durable goods orders in the U.S. beat expectation. Consumer confidence, like we said, down in the dumps. Huge miss. This is not a percentage, by the way. It's not 98.7 or something percent. No, no, no. That's just a ratio, and it's down. And then U.S. GDP negative. Well, are we? It is an interesting question as to whether we're in a recession right now. Are we seeing negative growth, and is it going to be for multiple quarters and et cetera, et cetera? This is debatable. We might literally be in a bit of an economic recession right now. I mean, GDP just printed negative 1.6% as an example. So, part of why you're seeing the slowdown, and you can understand why some of these commodities and things have come off so dramatically. But there's a lot to discuss in terms of these markets. I mean, there's just a lot of moving parts. So, as we look at the weekly performance, of course, equity's not doing well. Crypto's still struggling, but it's kind of sticky around that 20,000 level. And the range is more kind of You get a spike down to 18,000 in Bitcoin, you're probably a buyer. You get a spike up to 22,000 in Bitcoin, you're probably a seller type of idea in the crypto markets. Again, I think we're in that washed out phase. Oil staying strong, but we're going to look at a couple of charts of oil. I think we're starting to see oil and energy and some of those things fade off. I wouldn't expect it to be, anything catastrophic by any means. I don't think we're going back to 70 a barrel oil in the short term, but can we go down into the 90s? Yeah, I think that's where we're headed. And part of it is the economic slowdown. I think there's going to be a demand slow, frankly. I think consumers are pulling back. I think there's a lot of things happening that way. Let's look at a few of these charts together and kind of make sense of things. So let's start with the S&P. You can see we've kind of been in this downward trending phase, obviously, just pressed and kind of failed against a declining 20 period moving average, which is below the 50, which is below the longer term. You're just in a really clear, kind of clean bearish market environment. I am not mega bearish here. I kind of think this is just choppy. Wouldn't be shocked if we kind of are in an ABC, to use an Elliott wave reference, corrective pattern. Ultimately, we should resolve to the downside, would be my best guess on kind of the price action, but nothing that I really want to pound the table on necessarily. US dollar, I mean, I think this is the chart of all charts when it comes to currencies and financial markets and so on. We've broken out. I mean, we're above 2020 levels. We're, huge cup and handle has formed and is now breaking. This is just, it could get really sharp and really steep here for a while in US dollars. And I think that's where it's headed. I mean, fast forward a few months from now, what do I think this dollar index is trading? I don't know, 108, 109, 110. I mean, that's a big move in currency land, but it's not going to be a straight line and you'll just kind of pick your spots. But as I've been saying here recently, I think you have to be a dip buyer in US dollars for the foreseeable future. I don't see anything here in this chart that deters that opinion. And yeah, I mean, this is a long-term chart. So that doesn't mean, within a long-term uptrend, you can have a couple of weeks here and there where the dollar kind of struggles or consolidates or is just choppy. But the path of least resistance seems to be on the upside. So as we look at price action, Swiss franc, is it fully priced in? I don't know. I mean, big changes in their policy. It's still in that upward phase. You kind of have to trade that momentum until it shows a big exhaustion. We'll look at those charts. You're getting a little bit of a mini exhaustion, kind of flush out on the upside perhaps today, but CAD continues to trade well. I've liked CAD for a long time. I've really liked energy and been on board with that. As I said, this is the first time you're going to hear me say this. I talked about kind of taking off some energy plays that I was in a few weeks ago. But as far as CAD, I haven't been bearish on it at all. I think you can start to look to fade CAD a little bit. And that's not so much in the charts as just the expectation. I think yen, talked about the Japanese bond market's doing some wild and crazy things, and the Bank of Japan has not blinked yet. Will they, and will that fuel a huge move? They have the possibility of having a reaction that's greater than the Swiss franc. So Swiss franc, major policy change, and you've seen that currency explode. The same thing could happen in Japan. Now, it is, they call trying to buy the yen the widowmaker, and they call it that for a reason, because everybody wants to be the one that calls the bottom in the yen. That's been a currency that's been devalued for many years. I don't think that I can predict the bottom or anything like that. I'm not in the Widowmaker game, okay? But I'm just saying that from a risk to reward perspective, it seems to me one should be careful shorting the yen going forward. I don't know that you can buy it, but I talked about this last week. Just be careful shorting it. There's there's some things happening in that market that you could wake up one morning and the yen could be up 5%. I mean, it's just not, and that's a gigantic move, and that's would be historic and it'd be talked about, and it's just a possibility. It's not a high probability, it's just a possibility. So I'm uh, treading very lightly as far as the yen and what's happening in their bond markets and so on. I'd be careful there. I think the easy trade is just, play things like the US dollar right now to the upside. Look at that for further upside and opportunity. The Swiss franc has certainly been a trading candidate for the past couple of weeks as they change policies, and that unknown, has to be priced in. If you're in crypto land, I mean, for me, maybe Bitcoin, maybe Ethereum is what you can trade. I would be very careful about these. Every much as much as we talked about the potential for crazy things in the yen, well, these cryptocurrencies, I would call them the fringe cryptos, right? The ones that are not as popular, not as big. Um, there's there are mass bankruptcies happening in crypto land. You've got firms going under. You've got question marks as far as Tether and all these different vehicles that, as to whether they're kind of Ponzi schemes in essence, that they're bringing in new capital to pay off old investors. And there's just a lot of wackiness. And these kind of fringe cryptos are going to have the most extreme volatility and have the biggest potential for busting. I mean, would it shock anyone if we talk in a couple of years and this no longer exists or this no longer? It just wouldn't shock me. Let's just put it that way. Now, that also means that they'll have the most gigantic short covering rallies. It's just going to be volatile. I would expect, frankly, that we'll come in within the next week or two and we'll be talking about how these are up 20% on the week. And wow, look at that. The problem is that even when they do that, they're probably only getting back to where they are right now. That's the issue. If you go down, you know, 20 or 30%, and then you have this crazy bounce back, we only got back to where you were a week or two before. And that's the wildness of down markets. So careful in those more fringe cryptos. Let's take a look at a couple of other things here. If you look at international markets, I mean, this is true. You could just pretty much check the boxes. We're below 20s, below 50s, sloping downward trends on all these. This is the S&P, international, crypto. I mean, they're all in sustained downtrends and just, you know, clear cut, straightforward, bearish trends overall. So I think it gets a little choppy in stock land and equities. I'm not too excited. I actually think there's better opportunity in currencies than right now for some movement. I think stocks will be a little choppy and a little bit dead for a while. Crypto, think this is kind of a washout phase, and now you get this volatile but just choppiness, and frankly it's been happening. We already have gone sideways for a couple of weeks, so maybe even that is getting ready to have the next big surge, the next big move in crypto. I wouldn't be surprised if it's another week or so of kind of this choppiness before it moves, but it's been consolidating for a while. Certainly that flush out, that washout to the downside that we talked about has occurred. Now, if we look at the rest of this week, you get some speakers out of the ECB, the Bank of England, and Powell speaking today. Powell just continues to say the same stuff. I mean, look, they have two mandates: to keep full employment and to keep price stability. The employment picture is not a problem. The price stability is, and they're on message that we're going to do whatever is necessary. In Canada, you're going to get GDP in the morning and core PCE price index. Now, this is, I think the annual number is in the 4 point something percent, and this is a key component that the Fed watches. So too high, it's not the extreme that you're seeing in some other components. We're not 9% versus their 2 target, but we're at 4% versus, I think it's like 4.5 versus their 2. So it's a little high. The Fed does watch that. This could be a little bit of a pushing point towards whether or not they're going to raise by 50 or by 75. If this disappoints, you can see that expectations are for a 0.4% increase. If that were higher than expected, the market will shift and kind of say, hey, more rate hikes, more severe rate hikes, bigger rate hikes, that sort of thing, would be kind of the expectation in essence. And, in terms of if it were to disappoint, which I'm not sure it will, but if it were to be at 0.2 or something, then all of a sudden the markets are going to have to kind of adjust the other way and say, oh, well, hold on a second. Maybe they're only going to raise by 50 basis points at this next meeting. So we shall see. PMI numbers, ISM manufacturing, compared to last time, significant slowdown, but still above 50, which shows growth. And those PMI numbers tend to bottom out before the markets. So you've really got to establish a bottoming point in services and manufacturing PMIs before this market's maybe ready for that next recovery and next phase. Let's go look at some charts together here. And if you have anything that you specifically want to look at, fire away. I'm going to pull up a few different charts and we'll just kind of look at these things together. So I'm on a 4-hour chart here just in the US dollar. And the trend and the momentum and all these things persist. On the 4-hour, you're just getting kind of another fresh breakout. Call it an ascending triangle, what have you. I think US dollar, you just kind of continue to play it to the upside. When you get dips, to me, those are dips worth buying. I mean, look at it on the 1-hour time frame. You're getting a little bit of a consolidation up here. For me, it'd just be kind of look at these bull pullbacks, get a setup, probably an opportunity. My guess is that you don't have to do anything right here, right now, but ultimately the path again is towards higher prices. So in US dollar pairs, I just think you have to be neutral to bullish. That's the way I see it. It doesn't mean it has to work every day. It won't work every day and every week and every minute, but overall, it's the path of least resistance and certainly an area I want to look at. Euro USD is kind of interesting. Let's go look at that one together. If we pull up Euro USD, the reason I'm highlighting this one is just the psychological nature of this. So think about what's happening in Euro USD. Now we're on a daily time frame. First things first, well, you're still downward trending. Descending triangle. Does it look like Euro USD is going to break those lows? Yeah, I think it is. I think that's where we're headed. But look over here on the right-hand side and think about what numbers we're at. And there is a big number when it comes to currencies, and that's par. That's fair. It's basically when you get to even value. 1 euro is worth 1 USD, right? And that's a significant psychological number. It's akin to when gold first went to 1,000 an ounce and oil goes to $100 a barrel, and all these kind of psychological markers, the Dow hitting 20,000 and 30,000 and 40,000 on the index and so on and so forth. In currency land, anytime a pair is trading in the vicinity of parity, where one would be one, right? That's kind of significant. And I think we're going to get now, it's still a ways off. That's 400 and some odd pips away. We're still talking about, I mean, that's, on a percentage basis, just to kind of put it into perspective, that's still a long ways off. I'm not saying we're like on the cusp of that, because you're still 4 or 5% away from that. That's not going to happen this week or anything like that. But do I think that's where we're headed? Are we going to be talking about parity in Euro USD? That $1 will now get you €1. I think that is a story that can happen later this year, first part of next year. I mean, it's going to be a process. But if you look at that US dollar index chart, and I was talking about, where's this thing headed? Well, higher over time. In essence, you're kind of looking at this chart, which is the biggest component of it, and saying lower over time. So, I mean, here, if you look at this, kind of an inverse cup and handle, you're up at 108, the support's around 104, you break here, you should be headed towards 1, kind of on a measured move basis. How big you are here, about how far you go on this side, and so forth. I think we're headed towards parity. So something of a long-term price target, not anything that's going to play out in the short term. Swiss franc versus the Japanese yen. So this one's tough for me in that I root on the Swiss franc, okay, trade. If you're trading Swiss francs to the upside, we touched on it last week. It was a game changer, by all means. Trade it to the upside, keep trading it to the upside. The yen is the part of that that makes me nervous. I don't personally think the Bank of Japan is on the cusp of making major policy changes. I don't. They're slow to move. They're accommodative. They haven't blinked. But boy, there are some things that are happening in their markets that have to give them a little bit of heartburn. Where you're seeing what's happening in their bond markets and so on, and they have to start thinking about, man, do we need to start changing? Not that it's going to happen immediately, but remember, the market's going to kind of sniff that out and price it in ahead of time. So, I like the Swiss franc, but I just wonder if you can trade it to the upside against something else. Just, make a swap. How about, instead of trading it versus the yen, what if instead you did it versus the CAD or the Aussie or against the euro, which tend to be correlated, or what have you. Here's euro Swiss franc, and you can be shorting the euro. It still gets you long the Swiss franc. It's still very similar, but it just takes an element, I guess, of risk off of that. I mean, look, maybe I'm worried about nothing, and that's fine. But I'm just cautious when it comes to the yen right now. I'm just, maybe I'm too scared. Maybe I'm too afraid. But I've lived through a lot of weird stuff in currency land, the Swiss franc, removal of their hedge, all these sorts of things. What you just saw in terms of policy shift in and the way that it moved the Swiss franc, if the if the Bank of Japan were to do something similar, it would be like that move times 3 or 4 or 5 probably. There's just such a heavy short position in the yen that it's like a lot of dry wood that could just burn up quickly. So pretty kind of scary to think about if there was some major shock in and change in their policy. Swiss franc versus the CAD. So yeah, I mean, these are, so anytime you're trading Kiwi, CAD, Aussie, kind of in that commodity space, in that area, but Swiss franc weaker than the CAD quite clearly. Has broken some levels of support there on the daily chart. If you were to come in to shorter time frames, let's go to a 4 hour or something like that, you might be due for a little bounce, right? The 1 hour, you're getting a little bit of a bounce. There may be a little bit of a corrective phase here for a few hours that might present the opportunity, but that is the general trend. If you want to be a little bit more speculative, and it is speculative, but I was talking about the US dollar, and here's the US dollar versus the Canadian dollar. Now, Canadian dollar has a little bit more correlation to oil prices. I think we might be in a phase where oil is trending lower towards the 90s and such. And I think US dollar is quite clearly broken out. This is a pretty chart. Here's USD CAD on the daily. Look at it. 130.50, big drop. Use a lot of strength to get back up, and it perfectly responds to that level of resistance. Small drop. Right back to rising moving averages. This, to me, this is something I'm trading. Now, I think we're in a cup and handle. I think this is a perfect buy point for that next phase to the upside. That would get you long US dollars and short Canadian dollars. And there's not a lot of risk to it. I mean, this thing should not trade below 128, and it should be trading up above the 130s in the coming weeks ahead. So this daily chart, obviously a little bit longer term outlook and price projection, but do I think that's headed up there? First stop back into resistance, and then the third time's the charm. We should break right through. If you want to know what my expectation is for this, pretty big target actually. 130.50 down here. Let's keep it conservative and call it 128.50. That tells you that 132.50 is kind of the measured move target, and that's 400 pips. I mean, it's substantially higher. Now, that's not a short-term target, but that's where I think we're going in the coming weeks. So I think this is an area that could be pretty awesome, actually, for trading USD CAD to the upside. Does the US dollar rallying create some other problems in the economy and the markets? Yeah, you're already seeing it within corporations. So remember, any company that's what we call a multinational, they do a lot of business outside of the US. Well, they're getting paid in other currencies, and then when they convert them back to US dollars, it's a smaller earnings amount. So that those currency conversions can hurt them or help them. Strong dollar, it'll hurt the multinationals more. So anything that does business in the US, small cap companies, doesn't really affect them. But Google, IBM, Microsoft, all these companies that get a lot of revenues outside of the US and so forth, it hurts them, no question. It also is just, it hurts other countries. A lot of debt. If you're an emerging market, you live in Brazil, Russia, India, China, et cetera, you might have a lot of consumers that their debt is actually in US dollars. So imagine you work and you get paid in, your Brazilian real or whatever, but you have a loan in US dollars. The stronger the US dollar is, the more indebted you become, the more expensive it is to service your debt. A lot of corporations outside of the US, even though they do their work outside of the US, they still price their debt. They still take on debt in US dollar terms. So there are some real negative ramifications perhaps to stronger US dollar, but look, you trade the market you have in front of you and the US dollar is broken out to the upside. So I would tend to think that these will continue to go in the path of least resistance. I traded I made a couple of good calls in US dollar. I don't try to pat myself on the back because I make some bad calls too, but I really saw the US dollar kind of trade for what it was. That first push, it would probably have this kind of false break, and then it would plunge back in, and we talked about it and traded that pretty well. And now I think it's on to the next phase, which is, hey, that's clean. It's broken out. It's doing exactly what it should, and for the foreseeable future, US dollar should be climbing higher. That's not a great, that's actually, bad for commodities. It should kind of help. It's part of why inflation should come down, why a lot of prices have already rolled over, and will probably continue to do so. So kind of interesting. Yeah, Kiwi yen. I mean, if you want to trade Kiwi or any of these, you just have to be mindful of the yen aspect of it. I can see that a lot of our traders are trading yen, and I can't say I blame you from a charting perspective. I mean, look, it makes sense, right? You trade the trends, you trade the setups. I'm personally not really into the yen trades right here, right now. I might miss out on something, but the risk to me is just I don't want to sleep at night worried that something crazy happens and the yen moves 5% on me. Not that that's likely, but it's just not a risk I need to take. So I'm kind of avoiding the yens, but Kiwi against something else. You were talking about Kiwi on the downside versus the yen. I mean, that's a possibility. If you were trading the yen, I suppose that actually the trade that is less risky is to try to buy the yen. Now that goes against its trend and kind of overall momentum, but if something if the Bank of Japan moves and reacts and so forth, it should be yen screaming higher. So, there is a potential payoff there. I'm not sure it's a high probability betting on the yen going up, but just some words of caution, I guess, is the best way to put it. For the rest of this week, calendar wise, we've got how to trade the Swiss franc. There you go. We're going to be putting out a video on this tomorrow. I'm not sure who's doing that video, but they'll talk about probably the history of the Swiss franc, maybe the time they removed their hedge or they had basically linked and tied their currency to the euro, and it was quite a historic change when they removed that peg to the euro. So anyway, good position sizing, trade where there's some momentum, think about the risks, the rewards, the probabilities, and work your way forward from there. Thanks everyone for being here. Have a great rest of your week, and we will see you next time. Goodbye, everyone.